Namaste, good morning. We start the session with one other interesting topic which has an depth of idea, that is capital gains. We started with capital gains. It can be a standalone question or it could be a question along with the main aspects. Okay, we are starting with capital gains. Let us consolidate the provision once before going into and answering the questions. Okay, capital gains. A quick consolidation of provision for some time so that you become more clear. So, what is capital gain? The two conditions are it should be a capital asset. Okay, it should be a capital asset. It should have been, okay, transferred. It should be a capital asset. It should have been transferred. So what is more interesting is what is not a capital asset. Okay, following are not capital asset. Okay, following are not capital asset. வேண்டாம். Okay, ரொம்ப அபசகுனமா இருக்கு. Okay, following are not capital asset. Okay, right? Stock in trade, rural agricultural land, movable personal assets other than art, architecture, jewelry, painting, okay, similar things, okay. And let's leave about this bonds and special bearer bond, gold bonds. So these are all the things to be understood. Okay, these are all considered as capital asset. The not capital asset, anything other than that is a capital asset, and it should be transferred. That say the word transfer is big. Sale, exchange, relinquishment, okay, extinguishment, okay, extinguishment, compulsory acquisition, okay, conversion of asset into stock in trade are all considered as transfers, are all considered as transfer. Okay, even destroyal is a transfer, compulsory acquisition is a transfer, conversion, and this cooperative society members selling or TOP, Transfer of Property Act, all these things are considered as transfer. That leads us following or not transfer. Following or not transfer, gift or inheritance. Okay, gift or inheritance is not regarded as transfer. Amalgamation, demerger, holding subsidiary. Okay, provided transferee entity is also an Indian entity. Okay, both transferor and transferee should be, obviously provision is applicable for transferor, so we can easily understand transferee entity should be an Indian entity. Amalgamation, demerger, holding subsidiary. Yesterday we saw conversion, okay, into sole proprietor into company, firm into company, the company into LLP, all type of conversions are not regarded as transfer. All types of conversions are not regarded as transfer. On a broader scale, this is sufficient. Though we will be studying in IFSC related provision, some transactions pertaining to IFSC, that is International Financial Service Center, okay, are also not regarded as transfer. On a broader scale, this is sufficient. Okay, we all know assets are okay, then we all know the classification. Okay, we all know the classification STCA, LTCA. We all know the classification: short-term capital asset, long-term capital asset. STCA is defined, and one which is not a STCA is LTCA. Okay, listed shares, units of equity oriented funds. Okay, 12 months or less. Unlisted shares, immovable property, 24 months or less. Others, 36 months. Okay, so here one which is not a STCA is LTCA. One which is not a short-term capital asset is a long-term capital asset. Okay, so this is the classification. This is the classification of STCA and LTCA. Why do we classify? Why do we classify? Two reasons for classification. Okay, two reasons for classification. Indexation. Okay, indexation benefit is available. Okay, here in the case of STCA, okay, indexation not available. Okay, normal rates of taxation, but for STCG on which STT is paid. Okay, so special rates of taxation. Okay, right, that is 112 20%, 112A 10% of LTCG exceeding rupees okay, exceeding rupees 1 lakh. Okay, this is why we classify. This is why we classify. That is, the indexation benefit is not available for STCA and the rates of taxation are different. That is why classification gets importance. Okay, when we go into the format of working, what are all the things to remember in format of working is it starts with the first term called full value of consideration. It starts with the first terminology called, okay, full value of consideration. Okay, the format of working starts with full value of consideration. What is full value of consideration? Okay, normally sale consideration. In normal circumstances, we call the sale consideration as full value of consideration. However, deemed consideration in some cases. However, deemed consideration, that is, we will not take the sale consideration, we will take a deemed consideration in some cases. What are all the case? Okay, extinguishment of assets. Extinguishment of assets, that is, assets getting destroyed. Extinguishment of asset. Insurance compensation is the deemed consideration, is the deemed full value of consideration. We will get insurance compensation, that is the full value of consideration where the asset is destroyed. Extinguishment of asset. Okay, conversion of asset into stock in trade. Okay, FMV on the date of conversion. Fair market value on the date of conversion. Fair market value on the date of conversion. Okay, that becomes the full value of consideration. Okay, then compulsory acquisition. Compulsory acquisition. Original compensation. Original compensation. The compensation paid by the government will be regarded as full value of consideration. Introduction of asset by partner. Introduction of asset by partner. A partner introduces asset into the firm. Value recorded in books. That is what we consider as full value of consideration. Okay, we saw in the partnership consolidation also, it will be recorded as full value of consideration. Dissolution of a firm. Okay, fair market value on the date of, important to remember, distribution. Okay, on the date of distribution, not dissolution. Fair market value on the date of distribution. Okay, liquidation of a company. Liquidation of a company. Okay, taxable only to the member, not to the company. For the company, that distribution of assets on liquidation is not taxable. So taxable only to the member. What is full value of consideration? FMV of asset distributed plus monetary consideration minus deemed dividend, nothing but share of reserves, nothing but share of reserves. Okay, nothing but share of reserves. Okay, okay, nothing but share of reserves. That is what is deemed dividend. That is, there are some dividend which is yet to be distributed. Adudiya share of reserve. Okay, then specified agreement. Specified agreement அப்படின்னா that is, I am giving away my land and building. Okay, and the builder demolishes. Joint development agreement. This can also be known as joint development agreement. Okay, okay, the builder gives me. Okay, right, FMV or stamp value of, okay, land and building allotted plus monetary consideration. Okay, taxable in the year of completion and registration. Okay, this is taxable in the year in which I complete and get it registered, and this is taxable in the year in which I complete and get it registered. Okay, okay, this is taxable in the year in which I complete and register the property. Specified agreement or joint development agreement. Okay, this is the methodology. Right. Okay, so next, section 50C. Okay, transfer of immovable property. Transfer of immovable property. Actual consideration or stamp value, whichever is higher. Okay, however, where the stamp value does not exceed 110% of actual consideration, then actual consideration will be taken. Okay, so actual consideration or stamp value, whichever is higher, where the stamp value does not exceed 110, that is the amendment, then actual consideration will be taken. Okay, section 50CA, transfer of, okay, unlisted shares. Transfer of unlisted shares. Okay, actual consideration or FMV. okay, of shares, whichever is higher. The merchant banker vachi you need to value. So transfer for actual consideration or fair market value, whichever is higher. So these are all the cases where deemed consideration will be taken. These are all the cases where deemed consideration will be taken. Okay, so wherever we are unable to see the full value of consideration, we will take the deemed consideration. Okay, we all know to an extent what is cost of transfer, expenses incurred for the purpose of transfer. Okay, let's not dwell detailed into it. Okay, so it's expenses incurred. Now coming to cost of acquisition. Now coming to cost of acquisition. Okay, see cost of acquisition? The purchase price plus expenses at the time of purchase. Okay, the purchase price plus if there are any expenses incurred at the time of purchase, then that will also form part of cost of acquisition. Apart from this, however, in some cases, deemed COA will be taken. Okay, in some cases, deemed cost of acquisition will be considered. What are all the cases? Asset acquired before 1/4/2001. The significance is 2001-2 is the year in which indexation started. So, asset acquired before 1/4/2001. Asset acquired before 1/4/2001. Actual cost of acquisition or FMV as on 1/4/2001. Okay, whichever is higher, whichever is beneficial assessee can take. Okay, and then came the amendment here for our year. However, in case of immovable property, FMV cannot exceed stamp value prevailing on 1/4/2001. Okay, in the case of immovable property, what happens is the fair market value cannot exceed, should not exceed, not allowed to exceed the stamp value prevailing on 1/4/2001. In case of immovable property alone, it cannot exceed the stamp value prevailing on 1/4/2001. Okay, right. Gift, inheritance, amalgamation, okay, demerger, okay, conversion, okay, HUF transfer, okay, all in all these cases, cost of the previous owner. Okay, cost of the previous owner. If the previous owner has purchased before 1/4/2001, same principle will hold good. That is actual cost or FMV as on 1/4/2001, whichever is higher, but it should not exceed stamp value. Okay, in all these cases, we will remember to do Manjula Jesha. Okay, wherever we are taking the cost of the previous owner, wherever we are taking the cost of the previous owner, we will ensure that we are also doing Manjula Jesha case, so that we are giving two answers to the examiner, one as per law, another as per Manjula Jesha. Okay, debentures converted into shares or preference shares converted into equity shares. Okay, okay, taxable when equity shares are sold. Okay, COA of equity shares will be COA of debentures or preference shares. So, such a conversion is not a transfer. The term, if it is converted, it is not a transfer. But when it is subsequently sold, When it is subsequently sold, the transfer takes place. So COA will be cost of acquisition of debentures or preference shares. Okay. Okay. I will do the table of shares alone separately. Okay. Depreciable assets. Depreciable assets. Okay. Depreciable assets. Opening WDV plus opening WDV plus additions. Okay. So if the sale consideration exceeds, then it is known as short-term capital gain. We all know. Okay. So for depreciable asset, opening WDV plus additions will be regarded as cost of acquisition. Okay. Slump sales, which is defined under 50B. Okay. Net worth of the unit transferred. Net worth of the unit transferred. Okay. Net worth of the unit transfer. Demerger for shareholder. For in the case of demerger, okay, X Limited. I am a shareholder of X Limited. X Limited gave me shares of Y Limited because X Limited split. Okay. Uh, Cost of acquisition will be okay. COA of demerging company into assets transferred divided by total assets. So in proportion to my, I purchased the shares of X Limited for 60 lakhs. Now, one third of the asset has gone to the other company. So my cost of acquisition will be 20 lakhs of the other company. My cost of acquisition will be 20 lakhs of the other company. Okay. So these are all some of the, okay, for additional consideration, nothing but enhanced by code. Cost of acquisition will be nil. Enhanced by the code, cost of acquisition will be nil. Okay. So these are all the important things with regard to cost of acquisition. With regard to cost of acquisition. Okay. Then comes, my dear friends, then comes our COA of shares. COA of shares. Okay. When I say listed shares, section 112A comes into picture. When I say listed shares, 112A comes into pictures where listed shares are acquired before 31/1/2018 because that is the date of that provision. So that's why I'm writing 31/1/2018. Step 1. Compare full value of consideration or okay FMV as on 31/1/18. Okay. Determine whichever is lower. Determine whichever is lower. Step 2. Answer of step 1 with okay actual cost. Determine whichever is higher. Other will be the cost of acquisition. For listed shares, two steps. Listed shares acquired before 31/1/2018. Two steps. Okay. If full value of consideration or fair market value as on 31/1/18, whichever is lower. Okay. That answer with the actual cost, whichever is higher becomes it. Okay. Listed share, where listed shares are acquired on or after 31/1/18. COA, cost of acquisition will become okay. There is nothing. Cost of shares will be cost of acquisition only. There is nothing else. Okay. Bonus shares nil. However, for bonus before 1/4/2001, FMV on 1/4/2001 can be taken. Okay, so for bonus shares, it is nil normally. For a bonus shares allotted before 1/4/2001, by interpretation of law, we take the FMB as on 1/4/2001. Otherwise, unlisted shares, all these things does not have a separate provision. Original cost plus any expenses incurred at the time of purchases will be taken. Okay, they will be taken. I'm not dwelling too much on cost of improvement. You know what is cost of improvement. So I'm going to, okay, indexation. I'm going to indexation. ICOA. Indexed cost of acquisition is cost of acquisition into CII of the year of transfer divided by CII of the year in which asset was first held by the assessee. Okay, the asset was first held by the assessee. Here is where the gift or inheritance, it will be year of gift or inheritance, year of amalgamation, year of demerger, and Manjula Jaisha case comes. Okay, the only other thing the law says is or 100 where it is purchased before 1/4/2001. Okay, whereas ICOI, COI into CII of the year of transfer divided by CII of the year of improvement. There is no special formula here. COA, it is improvement. Okay, divided by year of improvement. Okay, okay. Indexation not applicable for, okay, STCA, depreciable assets, okay, debentures and shares, debentures and bonds, okay, listed shares, section 1112A, that is where STT is paid, okay, where STT is paid. In that case also, it is not applicable. Majority of the non-resident taxation, because they are taxed at special rate, the benefit of indexation will not be available for them. The benefit of indexation will not be available for them. Okay, so these are all the cases where our indexation and things work. Okay, then when we look into exemptions on capital gains, okay, okay, non-business exemption. First, when we can speak about non-business exemption, okay, right? The first section which comes to our mind is section 54. Okay, and we will parallelly read section 54b. Okay, right? Okay, so why I am reading like this is for quick understanding. Okay, individual and HUF. Okay, transfer. Okay, is house property and which is a long-term capital asset. Transfer is house property which is a long-term asset. Okay, investment is house property. Investment is another house property or a new house property. Okay, new HP should not be sold within 3 years. Okay, investment should also be within 2 years or 3 years as the case may be. Don't worry about it. Investment is in new house property. If these conditions are satisfied, okay, exemption is where gross LTCG does not exceed 2 crores. Okay, exemption can be claimed for 2 houses where gross LTCG does not exceed 2 crores. Exemption you can claim for 2 houses. Okay, where gross LTCG exceeds 2 crores, okay, exemption only for one house property. Exemption is only for one house property. What is the exemption? What is the exemption? Actual amount invested or, okay, gross LTCG, whichever is less. Okay, whichever is less, and the new property maintain it for 3 years. In all the cases, the new property should be maintained for 3 years. Okay, the new property should be maintained for 3 years. Here also, it is individuals and HOF. Okay, transfer is okay, agree land, and it can be a LTCA or STCA also, so it is available for short term also. Okay, investment in new agree land, okay, new agree land, not to be sold within 3 years. Okay, transfer is agree land. Okay, there is a sub condition used for agree purposes in the immediately preceding 2 years. Okay, they are not questioning these things, but generally I am saying you. Okay, exemption, exemption. Okay, actual amount invested or gross capital gains. It can be LTCG or STCG, whichever is less. Whichever is less. So 54, 54B and 54F will all speak about the same thing. Will all speak about the same thing. So there is no big difference between these things. What is transferred, and they are not intricate testing. They are only testing the ability for you to understand and interpret the provision. Okay, right? Then comes okay, section 54 EC and section 54F. First, the 54 EC, the benefit is all assessees. Okay, all assessees, even a company, firm, anybody can claim. Okay, asset transferred should be a long-term capital asset. Okay, consists. Okay, sorry, should be immovable property. Asset transferred should be immovable property. Asset transferred should be long-term capital asset. It should be. It is available only for transfer of land and building, and it is available only for long-term capital asset. Okay, should have invested within 6 months in the bonds of NHAI or REC, National Highway Authority of India, or Rural Electrification Corporation. In the bonds of NHAI or Rural Electrification Corporation, I should have invested. I should have invested. Okay, exemption. Okay, actual investment or gross LTCG or rupees 50 lakhs, whichever is less, or rupees 50 lakhs, whichever is less. 54 is slightly, only slightly a mirror replication of this 54 with a small difference. Okay, individuals and HOF, asset transferred should be long-term capital asset other than house property. Other than house property, because if you sell house property and buy house property, get 54. Why do you want 54F? Okay, so sell jewelry, sell your vacant land, sell agricultural land, sell architecture, but invest in house property. So asset transfer should be a long-term capital asset other than house property. Okay, investment in house property. Okay, assessee should not own more than 1 HP on the date of claim of exemption. So you cannot own more than one house property on the date of claim of this exemption. Okay, right? Here exemption is on a formula based, okay, gross LTCG into amount invested divided by net consideration. Okay, if whole of the net consideration is invested, get the whole exemption. Otherwise, a gross LTCG into amount invested divided by net consideration. Then comes, okay, business oriented exemption, that is those which are available only for business, those which are available only for business. Section 54D, section 54D, compulsory acquisition of land and building forming part of industrial undertaking. Okay, 54D, compulsory acquisition of land and building forming part of industrial undertaking. Buy new land and building, don't transfer the new within 3 years. Okay, but don't transfer the new within 3 years. In all business exemption, both LTCG and STCG, because all business oriented exemption, depreciable assets will have STCG, and non-depreciable asset, that is land, will have LTCG. So exemption will be, okay, amount invested or capital gain, okay, gross capital gain. It can be both STCG and LTCG, whichever is less. We all know first we should give it to STCG because it is taxable at 30%, whereas LTCG is taxable only at 20%. Okay, 54G and 54GA, that is transfer of industrial undertaking from urban to non-urban or from any area to SEZ. Okay, to SEZ. Okay, right? Transfer expenses will also qualify, otherwise the same. Transfer expenses will also qualify for deduction. Okay, transfer expenses will, or otherwise the same STCG. Okay, furniture and intangibles will not qualify for exemption. Okay, so in other words, land, building, plant and machinery will only qualify for exemption. Furnitures, intangibles will not qualify for exemption. This is for 54G and 54GA. The last is something known as 54GB. Okay, it is partly domestic, partly non-domestic. Transfer of house property and investment in startup. Okay, investment in startup. Okay, what the startup should do is, the startup should invest it in plant and machinery. The startup should not invest it in personal assets. The startup should invest this in plant and machinery. Okay, right? So exemption, gross LTCG into amount invested by startup in plant and machinery or deposited, okay, or you can keep it deposited, divided by net consideration, okay, right? So, and then except 54 EC, in all other cases, deposit in capital gain account deposit scheme will also qualify, provided it is deposited, okay, 1 month before the everywhere it is 1 month before the due date of filing returns. Okay, so deposit date is still 30th September, only due date is 31st October. Yeah, okay. Then thank you, Vikrita. She just told me that in shares I have to mention ESOP also, cost of shares. I need to mention ESOP. Okay, right? It is the okay FMV on the date of exercising the option. Fair market value on the date of exercising the option. That is what is the cost of acquisition. Okay, so it's a fairly a very simple chapter. We are unwantedly complicating. Okay, in examination they will give you indexation. Never worry about it. Okay, and it will be to a larger extent a very simple question. Okay, if it is a standalone question or anything, it will be to a larger extent a very simple question. Okay, right? Capital gains. Question number one. In order to save time and to mitigate cost, assessee negotiated the sale consideration and got it enhanced by the authorities. AO failed to treat the said transaction as compulsory acquisition as the sale consideration was stood negotiated. Is the AO's action justifiable? No. Balakrishnan is the case. Okay, Balakrishnan is the case we have to refer. Okay, held by Supreme Court that the land acquired under Land Acquisition Act of the government. Hence, it takes the character of compulsory acquisition. Mere negotiation of compensation will not change its character. Mere negotiation of compensation. Just because you negotiated the compensation, it doesn't mean it is not a compulsory acquisition. It is the nature of acquisition is compulsory acquisition. Why to go for court and all? You go to the collector, you negotiate the sale consideration, etc. Okay. Refer Balakrishnan judgment. Refer Balakrishnan judgment, where you will understand it is a part of the sale consideration, compulsory acquisition. The assessee entered into an agreement to sell with the builder, which provides that both parties were entitled to specific performance of agreement. Under the agreement, assessee gave permission to the builder to start construction on the land. Pursuant to an agreement, a power of attorney was given by the assessee to a director of the builder company to execute and join in execution the sale agreement or sales deals in respect of properties after developing it into flats. Subsequently, a memorandum of compromise was entered between the parties. Clause 3 of the compromise deed confirmed that assessee has received a sum of 4.68 crores as a sale consideration. Clause 4 recorded that the balance sale consideration of 1.05 in respect of the agreement would be paid by 7 post-dated checks. Clause 5 stated that the last 2 checks would be presented only upon receipt of completion certificate. The last checks were given to the assessee, in which year the assessee is liable to tax. I have a land and building. I entered into an agreement to sell with a construction company. I entered into an agreement with the construction company. I gave them all the rights. Okay. Section 53 of Transfer of Property Act says, which we have know in deemed ownership, partial performance of a contract where I have given away through a power of attorney. It is not joint development agreement. It is power of attorney given to the other party. It will tantamount to sale. So I gave the power of attorney. The total consideration was fixed. A bulk portion was given as advance and the balance as 7 post-dated check. The last 2 checks can be presented only after the property's construction is completed. Now, the company argues or the assessee argues only on presentation of last check. Only on presentation of last check, the transfer gets completed. Whereas the income tax department argues as soon as the agreement is entered into, the transfer is completed, deferral of paying consideration will not lead to such a conclusion. Okay, it all resulted in Sreevathson case, I believe. Sreevathson Steels Private Limited. Any transaction which which enables enjoyment of immovable property be considered as enjoyment as a purported owner, therefore transfer of capital asset and levy. The definition of the term transfer includes, okay, as I told you, transfer of possession on partial performance of a contract. That's good transfer down. Okay, even in house property, the person who gets it gets by all transactions. You all know that takes place by POA because stamp duty issues. The object of this provision is to bring in any de facto transfer of immovable property held by Supreme Court, that on receipt of the last check, the right of immovable property stands extinguished. Hence, capital gain needs to be, on receipt of last check, on receipt of check down. Okay, on receipt, that is when the date of agreement itself, I'm sorry. Okay, on receipt of the check, it stands, it's the right of immovable property stands to be ceasing. Okay, it is not the last check on the date of receipt of checks. Okay, once the agreement is entered into, it is known as transfer and it is subjected to tax immediately. Once the agreement is entered into, my dear friends, okay, in the case of transfer of properties through power of attorney, it is not, even if the consideration is paid in a deferred manner, but once an agreement is entered into, you are liable for taxation. Question number 2. Refer Sreevathson. Okay. transfer means, okay, partial transfer as defined under 53A of Transfer of Properties Act. Transfer through POA will also be regarded as complete transfer. The date of receipt of consideration will be taken as the date of transfer, even if consideration is through post-dated checks. Okay, so it should be considered as the property as a completed transfer. Here, actually, the whole case is from a different perspective. It is from the company's perspective they argued, the buyer's perspective they argued, but from the seller's perspective, it is completed on the date it is executed. On the date it is executed, it is regarded as transfer. Question number 3. Okay, a similar question we have worked out when we did amendments also. Mr. Hari, a property dealer, sold a building in the course of his friend to Mr. Rajesh. So he is a property dealer. So in his case, building is a stock in trade, who is a dealer in automobile parts, for 100 lakhs on 1/1/2021 when the stamp duty value was 120 lakh. However, the agreement was entered into on 1/9/2020 when the stamp duty value was 108 lakhs. Hari had received a down payment of 15 lakhs by NEFT, acceptable mode, and from Mr. Rajesh on the date of agreement. Mr. Hari had purchased the building for 50 lakhs on 12/7/2019. 12/7/2019. Okay, this is part 1 of the question. Sorry, there are 2 questions. This is part 1. Part 2. Mr. Ravi, a retail trader, sold a residential house to Mr. Malish, a wholesale trader, for 50 lakhs on 1/2 when the stamp value was 70 lakh. The agreement was entered into on 1/8 when the stamp duty was 55 lakh. Mr. Ravi has received a down payment of 5 lakhs by cross the check, not acceptable mode. Unacceptable modes are cash, bearer check, cross the check. Cross the check is negotiable, transferable. That's why it is unacceptable mode. Mr. Ravi had purchased the building for 32 lakhs. So it's 2 questions. First I'm answering question number 3, part A. Computation of business income of Mr. Hari, section 43CA is the guiding provision. Okay, sale consideration. Okay, actual consideration. Actual consideration is for 100 lakhs. Okay, okay, actual consideration. Stamp value on the date of agreement, since advance is paid on approved modes. Stamp value on the date of agreement. Okay, the agreement was however entered on 1/9 when the stamp duty value was 108 because they received advance, so it should only be taken 108 lakhs. Okay, 110% of actual consideration. Okay, 1 crore 10 lakhs. Okay, since stamp value does not exceed 110% of actual consideration. Okay, actual consideration will be taken. So you will take 1 crore. Last year it was different. This year you will take 1 crore. Okay, less cost of asset. When did he purchase? He purchased for building for 50 lakhs. Remember, he is a property dealer. Okay, 50 lakhs. Okay, his gross profit will be 50 lakhs. Hari, a property dealer, gross profit will be 50 lakhs. Okay, Hari, a property dealer, gross profit will be 50 lakhs. A quick look at from Rajesh and also it is not, because the inadequate consideration will not be taxable as the stamp value has not exceeded 110%, as the stamp value has not exceeded. So I'll just write, okay, for Mr. Rajesh, since the stamp value does not exceed 110% of consideration paid. Since the stamp value does not exceed 110% of consideration paid, okay, inadequate consideration provision are not applicable. Inadequate consideration provisions are not applicable. So for Rajesh also, it is not taxable. Okay, Mr. Ravi, a retail trader, sold a residential house to Mr. Valish, a wholesale trader, for 50 lakhs when the stamp duty on that date. The date of agreement, it was 55 lakhs. Mr. Ravi has received a down payment by cross the check. Okay, Mr. Ravi has purchased it on for 32 lakhs on 17/8/19, 2019. Okay, so part B. Computation of capital gains for Mr. Ravi. Okay, applying the provisions of section 50C, by applying the provisions of section 50C, full value of consideration. Okay, actual consideration, okay, 50 lakhs, actual consideration 50 lakhs, stamp value on the date of registration, stamp value on the date of registration, since advance is received otherwise than by approved modes. Since advance is received by advance is received otherwise than by approved modes. So on the date of registration, the stamp value was 70 lakhs. Okay, 110% of actual consideration, 110% of actual consideration is whether, since stamp value exceeds 110% of actual consideration, stamp value becomes full value of consideration. So stamp value will become full value of consideration, 70 lakhs. My dear friends, he sold on 1/2/21, purchased on 17/8/2019. 2 years have not lapsed. 2 years have not lapsed. 17/8/2019 na 17/8 or 16/8/2021 la தான் 2 years முடியுது. Okay, so he has sold it before that. Okay, less COA, as it is a short-term capital asset, less COA, he has purchased it for 32 lakhs. Okay, gross STCG, gross STCG is going to be 38 lakhs. Gross STCG is going to be 38 lakhs. For Mr. Valish. For Mr. Valish, how does this provision work? For Mr. Valish, how does this provision work? Consideration paid is 50 lakhs. Okay. Stamp value on the date of registration, since advance is paid otherwise than by approved modes, is 70 lakhs. Okay. 110% of consideration paid, 110% of consideration paid, 55 lakhs. Okay, the consideration paid, since the consideration paid is less than 110%, and the difference between stamp value and consideration paid is okay exceeding rupees 50,000, the whole of the inadequate consideration is taxable under section 56. Okay, so this 70 minus this 50 is taxable in the hands of Mr. Valish because he has not paid the full inadequate consideration. Question number 4. Krishna inherited his grandfather's land in May 2013. His grandfather had purchased it in the year 89 for 12 lakhs. The fair market value as on 1/4/2001 lakhs, whereas the stamp value is only 38 lakhs. Krishna sold this land okay, for 2.75 crores. Stamp value on the said date is 3 crores. Compute the capital gain in the following circumstances. Okay, using the proceeds, Krishna invested in 2 apartments costing 80 lakhs. If 2 adjacent flats and the in-between partition is removed, will your answer change? If the property is registered in the joint name or in the name of spouse, will your answer change? Okay, I have a small request. Take it as house property, inherited from his grandfather, house property. If it is land, it will be only 54F. My intention is 54, but while typing, I made the mistake of typing it as land. Okay, take it as house property. Okay, take this as house property, then only the 54 will come, otherwise 54F will only come. If this is the only question, then 54 we can answer. These two are also there. So and there are two properties. So all the intention is to ensure that it is 54. But while typing, I typed it as land. Please take it as house property. Computation of capital gains. Full value of consideration. Okay. Actual consideration. Okay. Krishna sold these lands in the previous year for 2 crores 75 lakhs. Okay. Stamp value 3 crores. 110% of actual consideration. Hence, actual consideration is taken. Okay, 2 crores. Since it is not exceeding, I'm not writing the theory. Now we have enough written that you are perfectly clear. Okay, even in TGBP we wrote it. So hence, to actual consideration, since it is not exceeding 110%, actual consideration will be taken less. COA, cost of acquisition. This land was purchased in for 1989 for 1 crore 20. Okay, okay. I'm sorry, 1 minute. If you have started doing the solution, no issues. Okay, you can continue like that. I am writing as per law, as per Manjula J. Shah. Okay, as per Manjula J. Shah. Okay, so that less cost of acquisition. Okay, inherited in May 2013. Inherited in May 2013. Before that, what is cost of acquisition? Actual cost or fair market value as on 1/4/2001, whichever is higher. However, FMV cannot exceed stamp value. The stamp value as on 1/4/2001 is only 38 lakhs. The stamp value as on 1/4/2001 is only 38 lakhs. Okay, I'll write the theory here. Since property is purchased before 1/4/2001, actual COA or FMV as on 1/4/2001, whichever is higher. However, FMV cannot exceed stamp value as on 1/4/2001. So FMV cannot exceed the stamp value as on 1/4/2001. So I take 38 lakhs into 301 divided by year of inheritance. May 2013 stands for 1314, 1314, 220. May 2013 is the year of inheritance, which is 1314, 220. Okay, divided by 220. This is as per law 38 lakhs into 301 by 220. Whereas as per Manjula J. Shah, 38 lakhs into 301 by 100. This is year of inheritance. Whereas Manjula J. Shah case says you need not. When you take the cost of acquisition of the previous owner, when you take the holding period of the previous owner, the benefit of indexation of the previous owner should also be provided. Okay, gross LTCG. Gross LTCG Okay. Okay. Gross LTCG. In the first case, it comes to 2 crores. It exceeds 2 crores. In the first case, it exceeds 2 crore. You can claim only for one property. In the second case, if you have opted for, if Manjula Jesha is acceptable, then you can claim for two properties. Okay. Exemption under section 54. Exemption under section 54. Okay, where the gross LTCG exceeds rupees 2 crores, exemption can be claimed only for one property. So here you can claim for 80 lakhs only. Okay, here's 80 lakhs only, where the gross LTCG does not exceed 2 crores, exemption can be claimed for two properties. So if I had adopted Manjula Jesha, I can claim for two properties. Okay, this is the key point to know how many properties for which I can claim. Okay, taxable LTCG. You need to give both the answers in the examination. There is no option for us till the clarity is obtained. Taxable LTCG. You can see the remarkable difference between Manjula Desha and Asper.
Sir,
You can.
sir, the difference between law and Manjula Jesha is only on the period of holding, sir.
Once more,
The difference between law and Manjula Jesha is
is
only on the
only
period.
on the indexation denominator.
Oh, for Manjula Jesha, we take actual, whereas for law, we take only from the date of inheritance.
Yeah, year of inheritance or year of gift as per law, year in which asset was first held by the assessee, law. Manjula J. Shah, if the previous owner's cost is taken, if the previous owner's holding period is taken, you should take the previous owner's indexation also.
And this is only for gift, will, or inheritance, sir.
Amalgamation, demerger, wherever you take cost of the previous owner.
Oh, okay.
If two adjacent flats and the in-between wall is removed, okay, we know this. Okay, if the in-between wall is removed, it becomes a single property. Okay, where we create such a okay, where we create. Okay, Syed Ali, Geeta Duhal. And assessee purchased two adjacent flats and created a common linking point or meeting point. Will he be eligible? Held by High Court, where there is a common meeting point or a separating wall is removed, then it will be treated as a single property. Okay, and the whole exemption can be claimed. In Anand Basappa case, even though there are two sale deeds for the purpose of exemption, it will be treated as only one. Okay, so if suppose the in between wall is removed, here also I can claim 1 crore 60 lakhs. Here also I can claim 1 crore 60 lakhs. Okay, right? Part B. Okay, in Syed Ali, Ita Dukhal, and Anand Basappa. it was held where there is a common meeting point, okay, two houses will be considered as a single property and exemption will be provided. Even though there are two sale deeds. Okay, even if you have two sale deeds, if there is a common meeting point, if there is a wall removal, then I will consider it as only single property and I will provide the exemption. In the case, even here I will claim 1 crore 60 lakhs because it becomes one property only. It becomes one property only. Part C, okay, the Kamal Wahal case, okay, right? You can see Kamal Wahal that the property is exclusively in the name of spouse. Also, you can claim Ravindra Kumar Arora, Gurnam Singh. Okay, Ravindra Kumar Arora, Gurnam Singh, Ravindra Kumar Arora, Kamal Wahal. All the three speaks about it can be the new property can be joint ownership or even exclusively in the name of spouse because you are going to be only the deemed owner. What the intention is, have you made the investment or not? Okay, if the property is registered in the joint name or in the name of spouse. Okay, Gurnam Singh, Ravindra Kumar Arora, and Kamal Wahal. Okay, where the new property is in joint names, exemption cannot be denied. Where the new property is in the name of spouse, exemption cannot be denied. Okay, in those cases also exemption cannot be denied, right? If you are manufacturing limited, a manufacturing company was transporting its machinery from one unit to another unit at a distance of 275 kilometers on 29th November 2020 by a truck. On account of civil disturbances, the machinery was completely destroyed. The insurance company paid 22 lakhs for the destroyed machine. On this fact, for submitting the return of income of the previous year, your advice is sought to A. Does the destruction result in transfer? How would the amount received from the insurance company be treated as tax liability? Will the company be able to save tax by investing in 54 EC bonds if the compensation results in capital gain? Question number 5. Part A. Yes. Okay. Um, Destruction of mission is treated as extinguishment of asset. Okay, the term transfer includes extinguishment. The term transfers includes extinguishment, so it will be definitely regarded as transfer. Okay, it will be definitely regarded as transfer. Part B. The compensation paid by the insurance company. The compensation paid by the insurance company will be regarded as full value of consideration. This will be reduced from the block of asset value. Okay, so opening WDB, addition less deletion, you will write compensation received from insurance company. Less deletions will have compensation received from insurance company, so that you will get a capital gain. So that you will get a capital gain, or you might or might not. Okay, since it is a depreciable asset, resulting capital gain will be short-term capital gain. The resulting capital gain will be short-term capital gain. Part C. Part C. The part C of the question asks, will the company be able to save by investing in 54 EC? Because one of the conditions of 54 EC says asset transferred should be a long-term capital asset. Asset transferred should be a long-term capital asset. A machinery got destroyed, insurance company paid compensation, you get short-term capital gain. Can I invest in 54 EC and get exemption? On a plain scale, we might say no, but there is an extraordinary interpretation in a case of, where the court has held asset destroyed might be a long-term capital asset, giving us a short-term capital gain. Once more, asset destroyed, and the machinery might be there for more than 3 years. That machinery might be there with us for more than 3 years. So it partakes the character of long-term capital asset, but the resulting gain is a short term, so you should not take like that. VS Dempo Company Limited, VS Dempo Company Limited, held by Supreme Court. According to section 50, the resulting gain on sale of depreciable asset is always short term. This does not mean that the asset is also a short term capital asset. Classification is different from computation. It is a LTCA producing STCG. So exemption can be claimed. This is a classical judgment where we understood classification different methodology, computation depreciable asset okay. For depreciable asset, we all know resulting gain is short-term capital gain because we compare the opening WDV and say, but that doesn't mean asset is there for less than 2 years, 1 year. It might be there for longer time. Okay, so part C. Okay, in BS Dempo case, it was held that the resulting gain might be short term, but the asset might be long term. The asset might be long term. The gain might be a short term capital gain, but the asset might be long term. Hence, 54 EC can be claimed against such STCG. Against such a STCG.
Sir, 54 EC, the asset should be land or building.
In this case, yeah, I accept with you. The question was okay. Yeah, I take that answer. When I framed the question, the intention was different. Yeah. However, since the asset is not land or building, immovable property, 54 EC cannot be claimed. But when this section came, when this case law came, 54 EC is for all assets. Then the amendment came, it is only for immovable property. That's why you see this difference. Now it can only be building. I got your answer. I got your overall conceptual answer. But when this case came, 54 EC was for all assets. That's why this question is retained by me as it is to make you understand. Question number 6. Mr. X was the owner of a residential house comprising of 2 floors. In April 2020, he entered into a collaboration with Arihant Builders for developing the property. According to the term, Arihan builders were to demolish the existing structure on the plot of land, develop, construct and put up a building consisting of 4 independent floors. Mr. X is to be allotted 1 floor and 25% of undivided land area. The cost of construction of each floor was 1 crore, which was borne by Arihan builder. The stamp value of the land, whole land amounted to 5 crores, and in addition, X was paid 40 lakhs as monetary consideration. You are required to discuss and resolve the following issues in assessment of Mr. X as a result of above transaction. For computation of capital gain, what will be the full value of consideration accruing as a result of transfer? If Mr. X has acquired the property in 2003-4 for rupees 74 lakhs, what will be the capital gain? What are all the various ways by which X can plan reduction of capital gains? This is that specified agreement. I have drafted this question only for specified agreement. Okay, joint development agreements. I will compute the capital gain as it is. It will answer the question also. Full value of consideration will be, okay, stamp value of land allotted. Stamp value of land allotted, you can see that the land, okay, that the stamp value of whole land amounted to 5 crores. He is allotted 25% of undivided land area. Okay, 5 crores into 25%. Okay, stamp value of building. Okay, we take, since the information is not available, we take it as 1 crore. We take it as 1 crore. Okay, normally whatever is the cost of construction or whatever is the cost, they register it as stamp value. Okay, monetary consideration 40 lakhs. So the full value of consideration will be stamp value of land and building plus monetary consideration, if any. Okay, this will be the full value of consideration. Okay, SICOA. He has purchased this land for 74 lakhs in 2003-4. 74 lakhs into 301 divided by 2003-4. 2003-4, 109. Okay, 74 lakhs into 301 divided by 109. Gross LTCG. Okay, this LTCG will be computed in the year in which the property is completed and handed over to Mr. X. Okay, that is the year of computation. In this question, it is happening immediately. Otherwise, it will be now. Okay, what are all the various ways X can plan? Okay, section 54 EC investment. Okay, it can go up to rupees 50 lakhs. Okay, purchase of another house property. Purchase of another house property. These are all the ways that X can plan his investment, his savings.
Sir,
Raja?
the stamp value of building, you took it as 1 crore in the absence of information, sir.
Amam. But normally itself cost of construction தான் அவங்க ஸ்டாம்ப் வேல்யூவாக ரிஜிஸ்டர் பண்ணுவாங்க when they are registering, so we can take it. Soumya purchased a residential house in April 2005 for 30 lakhs. She sold the house in November for 120 lakhs when the stamp value was 150 lakhs. Paid brokerage 1% of sale price. She invested 100 lakhs in an equity shares of Silicon Chips Private Limited, a newly formed technological company which qualifies to be a small entrepreneur. Soumya holds 29%. Even if you hold 26%, it is sufficient. You can claim a 50 GB. 50 GB. The company utilizes 100 lakhs is like this. 85 lakhs purchase of electronic equipment, 85 lakhs including 8 lakhs for air conditioner to be installed in office. This will not qualify. Deposit 15 lakhs. The due date of filing returns is 31st October. Assume that she has filed on 28th October. Compute the taxable capital gain arising from the above transaction. Read through. For cost of transfer, you will pay 1% of actual only. Because it's a brokerage, it will be paid 1% on sale price only. April 2005. So 30 lakhs into 301. April 2005 now 56117. 30 lakhs into 301 divided by 117. Gross LTCG. Gross LTCG is okay 7162 051. Okay, exemption under section 50 GB. 50 dB. You should have invested the net consideration. Net consideration is 1 crore 48 lakh 80,000. But you have invested only 100 lakhs, that is 1 crore. So you will not be enjoying the full benefit. You only proportionate benefit you will enjoy. Okay, exemption under section 50 GB. She has invested in an eligible company and holds more than 26%. So you will get the exemption. Exemption formula is okay gross LTCG into amount invested in assets except office appliances divided by net consideration. okay, plus deposits also, divided by net consideration. In this case, how it is going to work? Gross LTCG is 71,62,051 into amount invested, okay, it will be 100 lakhs plus 15 lakhs deposited minus 8 lakhs air conditioner, okay, sorry, 85 plus 15, sorry, 85 lakhs plus 15 lakhs minus 8 lakh divided by 1 crore 48 lakh 80,000. Repeating the whole formula, gross LTCG into 92 lakhs, because that is what qualifying, okay, 92 lakhs divided by net consideration. 27 lakh 33,901. 27 lakh 33,901.
Sir, the specified bank is capital gain account scheme, sir.
Hmm?
The specified bank deposit is capital gain account.
It's in the company deposit itself, which
Sir,
we
then how
say,
can we claim for that also as an
because they
investment?
say that it will be invested within 1 year in plant and machinery, otherwise it will be reversed.
Oh,
Question number 8. Beta Limited has two units, one engaged in the manufacture of computer hardware and the other developing software. As a restructuring drive, the company has decided to hive off its software unit as a going concern by way of slump sales for 520 lakhs to a new company called Theta Limited, in which it holds 82% equity shares. The balance sheet of Beta Limited being the date on which software unit has transferred is given under hardware fixed assets, debtors, inventories, current liabilities. There's a revaluation reserve 120. Software unit was in existence from 2016, more than 3 years. Fixed assets of software unit include land which was purchased for 40 lakhs, revalued at 60 lakhs. Fixed assets include the other. So total fixed assets is 200, out of which land they have said 60, we are going to take only 40. The remaining 140 is 200 minus 60, but whereas the written down value is as per books. However, the written down value as per IT law, okay, and the written down value as per IT law is 90 lakhs. Ascertain the tax liability for slum sales. As a tax consultant, how it would be better to change the to be more tax savvy than without changing the sale consideration. Okay, this is section 50B, slum sales. Question number 8, slum sales. Okay, 1, computation of net worth of unit transferred, that is the software unit. Okay, computation of net worth of the unit transferred. Okay, right, fine. Land 40 lakhs, land 40 lakhs. Okay, right. Depreciable asset, so if you want I will write it here, land, okay, revaluation to be ignored. In Income Tax Act, there is nothing called revaluation. Depreciation, depreciable asset, WDV as per IT law, WDV as per income tax law for depreciable asset 90 lakhs. Okay, 90 lakhs. Debtors 110 lakhs. Debtors 110 lakhs. Okay. Inventory 35 lakhs. Less current liabilities. Less current liabilities. Okay. Of software unit 90 lakhs. Okay. This is net worth of the unit transferred. Net worth of the unit transferred. Okay, 1 crore 85 lakhs. 1 crore 85 lakhs. Minute, because when you have this, okay, I shouldn't have missed this. Okay, and slum sales, that will also not have the benefit of indexation. Slum sales will also not have the benefit of indexation. Okay, this is net worth of the unit transfer. Okay, step 2, computation of capital gains. Computation of capital gains. Full value of consideration. Full value of consideration is 520 lakhs. 520 lakhs. Less, okay, net worth, which is the cost of acquisition. Okay, 1 crore 85 lakhs. Gross LTCG as the, okay, unit is in existence for more than 3 years. As the unit is in existence, so depending upon the unit period only, okay, 3 crore 35 lakhs is the gross LTCG. 3 crores 35 lakhs is the gross LTCG. Since the unit is in existence for more than 36 months, okay, the gross LTCG comes to 3 crores 35 lakhs. 3 crores 35 lakhs. Okay, okay, gross LTCG. Okay, how to be tax friendly. Instead of slum sales, if it is a demerger to a new company, resultant company, by following other conditions, it would not be regarded as transfer, hence no capital gain. Instead of slum sales, if you do it as a demerger. The second tax friendly advice is, if another, I think already they are owning 82%. Already they are owning if another 18% of shares of, okay, Theta Limited is obtained, then it becomes a 100% subsidiary. Transfer of asset by a holding to its 100% subsidiary is not regarded as transfer if the transferee is an Indian company. So if you do like that also, you will be able to save tax. If you do like that also, you will be able to save tax. If the transferee is an Indian company, okay, anyhow it's an Indian company, in that manner also your taxes will be saved. Otherwise, this is taxable at 20% plus surcharge. Okay, since it is more than 1 crore, less than 10 crores, hopefully business income is also like that, 7% plus HEC. X Limited, a company in which whole of the share capital is held by Y Limited. Both X and Y are Indian companies. X Limited had made investment in shares of ABC Limited in 1989 for 3 lakhs, which it sold to Y Limited on 1st April 2010 for a total consideration of 30 lakhs. The fair market value of these shares of as on 1/4/2001 is 20 lakh. Y Limited disinvested 5% in the shares of X Limited in January 2021 by sale to public. It sold the shares of ABC Limited in March 2021, acquired from X Limited for a sum of 70 lakh. Discuss the issue with relevant provision on tax effects of this transaction in the hands of X and Y Limited. So, what happened in 2010 is a transfer by holding company to its 100% subsidiary company, or a transaction between holding company and 100% subsidiary company, or vice versa, and the transferring company being an Indian company, it is not regarded as transfer. X Limited, a company in which whole of the share capital was held by Y Limited. Both X and Y are Indian companies. X Limited had made shares in ABC Limited in 1989 for 3 lakhs. This is sold in 2010 for a consideration of 30 lakhs. It will not be taxable in the year 2010 because it is transferred by holding an 100% subsidiary. No, it will not be, or 100% subsidiary to holding. The fair market value of these shares as on 1/4/2001 is 20 lakhs. Y Limited disinvested 5% shares in X Limited in 2021 by sale to public. Even if this information is not there, the transaction is the same. This information is just to 100% vechindalo. When you sell it out, it will become taxable. It sold the shares of ABC Limited acquired from X Limited for a sum of 70 lakhs. Discuss the issue with relevant provisions and tax effect in the hands of both X Limited and Y Limited in the relevant assessment years. Question number 9. Okay, the first point to understand: transfer of asset by holding company to 100% subsidiary company or vice versa will not be treated as transfer, provided the transferee company is an Indian company. Provided the transferee company is an Indian company, it will not be regarded as transfer. It will not be treated as transfer. Okay, so transfer of asset by holding company to 100% subsidiary company or vice versa will not be regarded as transfer. Okay, in the given case, the transaction of transfer of ABC Limited shares in 2010 will not be taxable for X Limited. X Limited then a transfer of, okay, X Limited had made investment in ABC for 3 lakhs, which it sold to Y Limited, will not be taxable for X Limited, okay, on transfer to Y Limited, okay. Okay, so in this given circumstance, asset is transferred by the holding company to its or vice versa, it will not be taxable at all because it is not regarded as transfer. It is not regarded as transfer. Okay, capital gain will arise when Y Limited subsequently sells the shares. Okay, this gain is irrespective of any holding in X Limited because they say 5% disinvested. Irrespective of that, this is going to be taxable in the hands of Y Limited. This is going to be taxable in the hands of Y Limited. Computation of capital gains. Okay, what will be the cost of acquisition for Y Limited? What will be the cost of acquisition of Y Limited? Cost to the previous owner, that is cost to X Limited, not the purchase price of Y Limited. Okay, because the transaction is not at all regarded as transfer. So cost to the previous owner. Whenever we take cost to the previous owner, we will work out Manjula Jesha also. Whenever we take cost to the previous owner, we will work out Manjula Jesha also. Particulars as per law, as per Manjula Jesha. I'll write the theory also, don't worry. Full value of consideration. Okay, full value of consideration. The fair market value is on 1/4. Y Limited disinvested, etc. This is sold for rupees 70 lakhs. This is sold for rupees 70 lakhs. Less ICOA. Less ICOA. Okay, I'll write the theory here. COA for Y Limited will be the cost of acquisition of shares of X Limited. Okay, the COA. Okay, consideration paid by Y Limited for acquiring the shares of ABC Limited should be ignored as it is not transfer. As it is not a transfer. So cost of acquisition of shares of cost of acquisition for Y Limited will be cost of acquisition of shares of X Limited. Consideration paid by Y Limited for acquiring the shares of ABC Limited should be ignored as it is not regarded as transfer. Okay, this is one point, please understand. Okay, since shares are acquired by X Limited before 1/4/2001, FMV as on 1/4/2001 can be considered. So what happens? Okay, it is purchased for rupees 3 lakhs. Okay, this this for a consideration of 30 lakhs to be ignored. FMB as on 1/4/2001 20 lakhs. Okay, 20 lakhs into 301 divided by date of on 1st April 2010. Okay, Y Limited on 1st April 2010. That happens to be 1011. That happens to be 1011. 167. 167. Okay, date of okay getting shares from X Limited. Whereas Manjula Desha says no, nothing like that. When you consider the cost of the previous owner, holding period of the previous owner, consider the indexation also. Computation is a smaller part. Theory is the lengthier part. You need to write for everything the detailed notes. Okay, in examination, state the obvious is the principle. So write the note why it is not regarded as transfer. Write the note what is cost of acquisition. Write the note why we are considering Manjula Desha judgment for this particular purpose. Only when you write these notes, you will be able to do it. Okay, only when you write these notes, your answer will stand tall. Okay, so state the obvious is the principle in the examination. Okay. For the question, our friend Abhiprita, for the two questions which our friend Abhiprita has asked me, tax effect in the last question, that is in this question, okay, what will be the tax effect? Okay, tax will be, let the theory be here, tax will be 20% of this because it is LTCG. Okay, surcharge at 7%, assuming that the total income is less than 10 crores only. Already capital gain itself is 3 crores. If it has exceeded, then let it be 12%, but as of now, 7%. Okay, and HEC at 4% will be this plus this into 4%. So the total tax will be these three. Okay, in this question, the total tax will be these three for ensuring that it is not falling into the ninth question. Okay, the total tax will be this. This is what is tax effect. Okay, that is how it is computed. With regard to this question, she has a point. Sir, in cost of acquisition of shares, which we compare on 31, will also don't have indexation, right? Yes. LT, listed companies shares on which securities transaction tax is paid. Listed company shares on which securities transaction tax is paid. இதெல்லாம் holding to subsidiary. They will not come through a market. So they will not be paying the securities transaction. If securities transaction tax is paid, then what you are saying is correct. This is not a transaction of STT. Okay. Question.
Sir,
Yes, sir.
sir, suppose there's a whole like 100% holding subsidy relationship, and suppose it gets disinvested. So the capital gain will arise only on the sale of shares post
Yes,
the disinvestment.
yes, sir. At the time of transfer, if there is a holding subsidy relationship, that is enough. Okay.
Is there a period of holding,
No, there
sir?
is no lock-in period. That's what I'm coming to say. There is no lock-in period here.
No, suppose I transfer the asset today and tomorrow the relationship ceases to exist.
There
Still
is
no.
there is no specific provision of lock-in period now.
Thank you, sir.
Question number 10. The 54G is the concentration. BM Limited, which owns an industrial undertaking in Delhi, decided to shift itself to a backward area in Haryana. Following the assets held by the company, plant and machinery opening WDV 42 lakhs, building 12 lakhs, industrial land acquired in 91 2 lakhs, FMV as on 1/4/2001 3 lakhs, sold the following: plant and machinery, building, land. New assets acquired: plant and machinery 15 lakhs, 3 lakhs subsidy received from government, land for which advance has been paid 20 lakhs, additional 5 lakhs needs to be paid. Compute the capital gains. for sale of land because that results in a long-term capital gain. First, let us do for sale of land. Full value of consideration, okay, 35 lakhs less ICOA, less ICOA, FMV is 3 lakhs. FMV is 3 lakhs into 301 by 100 gross LTCG, gross LTCG or STCA, particulars, plant and machinery, building. Opening WDV, okay, 42 lakhs, 12 lakhs. Additions, okay. Let me take it, doesn't matter, more than 180 days. Let me take it as more than 180 days. Doesn't matter even if you take it as less than 180 days. Okay. After adjusting subsidy received towards purchase of depreciable asset. If it is a depreciable asset, the subsidy received should be considered 15 minus 3, 12 lakhs. 15 minus 3, 12 lakhs. Land and building, which for which advance has been paid, so not yet put to use, so I can make it 0 here. Okay, I can make it 0 here. It is not yet utilized. Deductions. Okay, sale consideration will be 33 lakhs, 50 lakhs. Gross STCG, gross STCG. So this block exists, right? Gross STCG slash balance available for depreciation. Depreciation. Okay. This in 15%. Don't worry, that is not our main answer. Closing WDV. Okay, that is not our main answer. Don't worry. Okay, this is just a side answer, not our main answer. Amount available for exemption under 54G. Cost of new plant, cost of new plant 33 lakhs. Advance paid will also qualify. Will also qualify. Advance paid, okay, 20 lakhs. Balance payable will also qualify because you will obviously pay from this. Okay, total amount available. Okay, total exemption amount available is 58 lakhs. Total exemption amount available is 58 lakhs. Remember, advance paid will also qualify, payable will also, because investment need not be immediate. I mean, it can, you have identified and the transaction is theoretically over. Only the last part of the transaction is pending. So substance over form. On sale of land, I had a LTCG. On sale of land, I had a LTCG. On sale of building, I had a STCG. Okay. Exemption. First, I will provide towards STCG. The balance, if any, I will provide for LTCG because STCG is taxable at a higher rate. First, I will provide towards STCG and the balance I will provide towards LTCG. Taxable LTCG. Taxable LTCG is 5,97,000. 5,97,000. Taxable LTCG 5,97,000.
Sir?
Raja, listening.
Sir, the new plant which was acquired, isn't it 15 minus 3, 12 lakhs, sir?
Did I do it?
For amount available for exemption.
Okay, sorry. Yeah, 12 lakhs only. Oh, here also you're saying. Okay, okay.
Oh, yes.
Yes, sir. Sorry, sir. I took the cost. You're right, sir. Yeah, you're right, sir. I took the sale value. No, it is investment value. So 1225.
So that exemption also will change, sir.
Yeah, it has been changed. It will automatically change.
Here, sir, only 37 will come. Right, sir. Sir, why do we first adjust against STCG, sir?
Because STCG is taxable at 30%, whereas LTCG is taxable at 20%. As a tax planning measure, we try to do the adjustment towards STCG. This is a question where extensive discussion of 50C. Okay. Ashish Mehta owns acres of land which he has purchased in 84-85 for 6,10,000. Stamp value as on 1/4/2001 9,45,000. Ashish converts this property as stock in trade in 2017-18, recording a value of 50 lakhs, whereas the fair market value is 65 lakhs. Ashish spends 31 lakhs for construction and 2,45,000 for approvals. He starts developing the property in March 18. In April 20, he enters into an agreement to sell two houses for 40 lakhs each and receives advance of 10 lakhs for house 1 in cash, and for house through a check. Okay, stamp value of each house is 35 lakhs. In Feb 21, He completed the said property into 4 houses and sell them. The remaining houses were sold on 51 lakhs. Stamp value on that date is 45 lakhs for each house. Out of the sale consideration received, he invests 50 lakhs in NHAI and REC, another 50 lakhs. Determine the year of taxability of the conversion and the sale and the amount chargeable to tax under capital gains and PGBP. Also, rework the solution if the land was purchased as stock in trade, subsequently converted into capital asset. Fine. Okay. So it is a conversion also and application of 43 CA. Okay. Right. So full value of consideration, which is nothing but fair market value on the date of conversion. Fair market value on the date of conversion. Ashish converts the stock in trade in 1718, recording 50 lakhs, but the fair market value was 65 lakhs. Fair market value 65 lakhs, no cost of transfer, directly I go for less ICOA, less ICOA, okay, 9,45,000 stamp value, 9,45,000 into 301 by 100, 9,45,000 gross LTCG, gross LTCG, okay, 36 lakh 55,550. Gross LTCG 36 55 55 50. This is taxable. Sorry, not 301. I'm sorry. Numerator will be year in which of conversion 1718. I'm sorry, 1718 will be the numerator. Numerator will be 272. Numerator will be 272. Year of conversion. 272. Okay. This is taxable in the year in which stock in trade is sold. That is 2021 financial year. So this is not taxable in the year 1718. It is taxable, it is computed, but taxable only in the year in which stock in trade is sold. Taxable only in the year in which stock in trade is sold. So this will be taxable only in the financial year 2021. It is a gross LTCG, taxable at 20%. All those things are fine, but the year of taxation will be 2021. Computation of business income. Computation of business income. Particulars. House 1, house 2, house 3, house 4. Because he is selling it as 4 houses. House 1, house 2, house 3, house 4. Actual sale value. Okay. Here I am applying the provisions of 43 CA. Actual sale value. The first 2 houses are sold for 40 lakhs. The next two houses are sold for 51 lakhs each. Stamp value on the date of, okay, registration. Why? Okay, for H1 and H2, okay, advance was received otherwise than by approved modes. One is cash, another is check. Hence, SV on the date of registration should only be considered. You cannot take it on the date of agreement because you have received advance, one by cash, another by either bearer check or cross check. Unless account payee check, account payee draft, NEFT, okay, or RTGS, debit card, credit card, UPI, RuPay, like that a formal system is there. Otherwise, it will not be. So, in all the cases, I will take the stamp value on the date of registration, that is 45 lakhs. That is 45 lakhs. Hundred and 10% of actual sale value. Okay, so my dear friends, total sale consideration will be, total sale consideration will be 45 lakhs plus 45 lakhs plus 51 lakhs plus 51 lakhs. I am repeating, total sale consideration will be 1 crore 92 lakhs. In these two cases, I will take these two. In these two, house 3 and 4, I will take 51, 51. So my total sale consideration will be, oh, sorry. In these two cases, okay, I will take these two. Okay, I will take these two. In these two cases, I will take these two. So it will be, okay, it will be 45 plus 45 plus 51 plus 51. Okay, repeating, since in the house 1 and house 2 it exceeds 110%, stamp value will be taken as cost of acquisition. In house 3 and house 4, the actual sale consideration will be taken, so 1 crore 92 lakhs. Repeating, house 1 and house 2, the problem is you have received advance otherwise than by approved modes. So SV on the date of registration should only be taken. On the date of registration, it is 45 lakhs. 110% of actual consideration is only 44. Stamp value exceeds 110%. So I will take stamp value 45, 45 for house 1 and house 2, 51 and 51 for house 3 and house 4. So total sale consideration 192 less FMV on the date of transfer. Okay, we have that amount. FMV on the date of transfer 65 lakh. That is like my raw material cost. That is like my raw material cost. Construction cost. Construction cost. Okay, in fact, I completed the property. The remaining two houses are sold. Okay. Construction cost 31, approval cost 245. Okay, 31 lakhs, approval cost 2,45,000. So business income Business income will be 93,55,000. Business income will be 93,55,000 and capital gains. Now, okay, computation of total income. Business or profession as computed 93,55,000. Capital gains in the inner column because there is an exemption. LTCG, okay, LTCG in the inner column 39,29,600. Exemption under section 54 EC, you can claim only up to 39,29,600 because actual deposit, actual investor or gross LTCG subject to a restriction of maximum 50 lakhs. So it will be the other conditions being within 6 months of consideration received, it is deposited. All those things are assumed to have been fulfilled. All those things are assumed to have been fulfilled. Okay, you will wonder out of the sale consideration, 50 lakhs in NHAI and 50 lakhs in REC, only 50 lakhs can be availed. Just because it is invested in 2 different years, it doesn't mean you can get 50 lakhs for each year. Okay, it will not be so. It will not be so. Okay, right? Look through, I'll go for the next working. This is a theoretical answer. If originally it is a stock in trade, subsequently converted into capital asset. Originally it is stock in trade, subsequently converted. On the date of conversion, whatever is the fair market value will be treated as sale value of the stock in trade. It will result in book, or it will result in profit. Okay, on the date of conversion, whatever is the fair market value, what I will do it, I will consider it as if it is sold. Whatever is the fair market value, I will consider it as if it is sold. Okay, so capital asset converted into stock in trade. Fair market value on the date of conversion will be taken, but capital gains will be computed or taxable only in the year stock is sold. But here it is not so. On the date of conversion, I will take it as say as if it is sold. Take the fair market value as the sale value of the stock in trade. It will result in profit or loss, whatever it is. Capital asset will be recorded at FMV if it is a depreciable asset. Then depreciation will be provided. When the capital asset gets sold, when the capital asset gets sold, suppose when you are selling that capital asset, okay, cost of acquisition will be FMV on the date of transfer, on the date of conversion, or book value if it is a depreciable asset. Land na FMV on the date of conversion, other asset na depreciable asset. Okay, right? Period of holding will be computed from the date of conversion. this is the most important thing. Period of holding will be not from the date you had it as stock in trade. Period of holding will be from the date of conversion. Period of holding will be from the date of conversion only you will take. So when a stock in, rarely there can be a theoretical question, very very rare, even in the year of amendment I did not see this, but if a stock in trade is converted into capital asset, that will be capital asset converted into stock in trade, capital gain, stock in trade converted into capital asset, business profit. How will you know the sale consideration? Fair market value on the date of conversion is sale consideration. Tax it immediately. Don't wait for the asset to be sold. Now you have converted it and the capital asset is recorded at fair market value. If it is a depreciable asset, provide depreciation. In the year of sale, STCG will come. If it is land, if it is a non-depreciable asset, FMV on the date of conversion will be cost of acquisition. Remember, period of holding, whether it is LTCA or STCA, classification and indexation, period of holding will be the date of conversion. The date of conversion.
Sir,
Yes, sir.
could you just explain what is the book value in case of depreciable assets, sir?
WDV, that is cost FMV minus depreciating for various number of years, you will get the WDV. WDV is only, I call it as book value.
WDV as on the date of conversion.
As on the date of sale, whichever year you are selling, as on 1/4 of whichever year.
Okay.
This is just my addition. The original question did not have this. Question number 12. Mr. Shiv Narayan invested in a scheme of mutual fund rupees 11 lakhs on 1st January 2018 when the net annual value was rupees 100 crores. On 1st May 2020, when the net annual value was 180 crores, segregation of portfolio was created due to a credit event. Post creation, main portfolio had 150 crores and segregated portfolio had 30 crores. In March 2021, Shivnarayan redeemed the main portfolio for 11 lakhs. Specify the tax impact. This question leads us to this recent amendment of segregation of portfolio or side pocketing. Okay, segregation of portfolio or side pocketing. Okay, for the investor, how it affects. For the investor, how it affects. Okay, main portfolio can be redeemed anytime. Segregated portfolio cannot be redeemed. Okay, segregated portfolio cannot be redeemed. Cost of acquisition of main and segregated portfolio is in proportion to NAV on the date of side pocketing. Okay, is in proportion to the NAV on the date of side pocketing. Okay, acquisition of segregated portfolio will be the original date of acquisition and not date of segregation. Okay, will be the original date and not the date of segregation. So main portfolio can be redeemed. That's what the investor has done. Now, total purchase price, total purchase price, he has invested 11 lakhs. He has invested 11 lakhs. Okay, purchase price of main portfolio, purchase price of main portfolio 11 lakhs into, okay, 150 by 180, 150 divided by 180, repeating 11 lakhs into 150 by 180, okay, 9 lakh 16,000 and on. Okay, purchase price of main portfolio, purchase price of segregated portfolio will be 11 lakhs minus 9 lakh, okay, 1 lakh 83 333. Now when main portfolio is transferred, full value of consideration or redeemed, okay, full value of consideration 12 lakhs, transferred here means redeemed, full value of consideration 12 lakhs less COA, okay, cost of acquisition. It can be indexed, it depends upon debt or equity. It depends upon whether STT is paid. I'm not going into the computation. I'm just giving you the methodology. Okay, right? So, gross capital gain. It can have, if it is a debt fund more than 3 years, you can have indexation. If it is equity fund and if it is STT is paid, then you will not have indexation, but at the same time up to 1 lakh is exempt, like that it will go. So I'm just giving you the overall working. So though you have purchased it for 11 lakhs, when the mutual fund decide to segregate between main portfolio and segregated side pocketing, so you will rework the entire answer. You will rework the entire answer into, for main portfolio redemption, how much? This is the cost of side pocketed or segregated portfolio. When this is becoming normal and when this is redeemed, this cost will adjusted and the capital gains will be computed. But for computing, you will take the original date of acquisition only, original cost of acquisition only. Okay, so this is how this new amendment is taking place. It will be only a theoretical question, if at all, or if there is a practical question, it will be very clear. They will give you the date of acquisition, date of CII values, etc., for you to easily understand that. For you to easily understand that. Okay, right? So this is with regard to our capital gains along with amendments. Along with amendments, okay, to a larger extent, we have seen the case laws. The most in Manjula Desha case law, we saw conversion of leasehold into freehold is itself a cost of improvement. So only date of leasehold right we have to check. Balakrishnan case law we saw, okay, assessing officer, if they have given it for valuation, you should consider valuation date only. Okay, sale of fertilizer bond at a loss, will it be treated as business loss or capital loss? This is a new case law. I will tell you the facts of the case. Okay, government gives subsidy. Government gives subsidy, my dear friends, for fertilizer. Sometimes government is running short of money, so they give the subsidy in the form of bonds. They give the subsidy in the form of bonds which are freely transferable. So this company, Gujarat State Fertilizer and Chemicals Limited, received bond instead of subsidy. They sold the bond at a loss. and claimed it as business loss. The assessing officer contended that it is sale of bond, so it should be treated as capital loss. The court held where fertilizer subsidy is a business income, the bond also takes the business character. Had you received it in money, you would have taken it as business income because it is subsidy received. So the loss from arising from transfer of these bonds is a business loss. So the loss arising from transfer of these bonds is a business loss. Okay, please remember this case law. This is a new case law. Okay, whether construction before sale of property will qualify? Yes, it will qualify. Intention is investment. If you have invested, sometimes within 3 years you have not yet completed construction, you will get it qualified. Gurnan Singh, Ravindra Kumar Arora, Kamal Bahal, Syed Duhal, okay, Sambandham Mudrya, that's what construction not completed within 3 years. Still you can claim the benefit. B.S. Downbow, Gauli Mahadeva Pa, that is section 50C. If you get stamp value and you invest that stamp value, will you get the exemption fully? Yes. Will you get the exemption fully? Yes. Hindustan Lever Limited, that 54 EC bonds beyond 6 months. Beyond 6 months, will it qualify? Yes. When you have paid it within 6 months, don't see the bond date, substance over form. Okay, those cases should be taken out. Fiber board, இது நம்ம இப்ப 54G ல படிச்சோம். Advance paid will also qualify for exemption. Advance paid will also qualify for exemption. Sheshasai. So it can be a case law question, or it can be a straightforward computation. In my opinion, they are going to test that 142,001 and along with section 54C 110%. But whatever may be the question, capital gains will not challenge you to a larger extent. Simple case law, you will definitely remember the judgment if not the citation. So simple case laws followed by, if you follow that method of computation page once, if you just look through, that will take you to capital gains, whatever may be the question. Okay, our morning session ends here.